Hi guys, this is Mosh. Welcome back to another one. If you're new here, click on that subscribe button. If you want to see my daily trades, my profits, my losses, any updates, what I'm investing in, check out my Instagram and Twitter pages. I'll link it in the description below. In my last video, I promised you guys I would do a video on compounding. Being a physicist, Einstein said this quote, "It's the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." So here it is. Using this method can make you a millionaire, even if you don't have a lot of money to start off with. And I'm going to talk through exactly how to do it on different budgets. So what is compounding? The textbook definition is the process in which an asset's earnings, either through capital gains or interest, is reinvested over time. Now, what is capital gains? Capital gains is just the increase in the value of a share or an asset. So for example, your house price might increase 5% every year. So over time, it's increasing value. Your share price might increase over a couple of years. If you don't want to work till 68, which is the retirement age of the UK, you have to do this method. And the earlier you start, the better it is for you. Using this method, you can be a millionaire when you retire. Before I show you step-by-step calculations and exactly how it's worked out, there's a couple of assumptions that we need to make. Now, I've done all the research, so you don't have to. The first thing is looking at average annual return. So average annual return is made up of three things: share price appreciation, capital gains, and dividends. Now, for the S&P 500, so the top 500 companies in the US, the average annual return was 9.8% over the last 90 years. The average annual return for the FTSE 100, so the top 100 companies in the UK, was 7.8% from 1984 to 2019. And the reason why it's 1984 is that's when it was created. The average annual inflation was 3.22% for the last 100 years. So what I'm going to do, I'm going to break it down in terms of three budgets, and I'm going to include and exclude inflation in each of those calculations. The first one is going to be a low budget. The second one is going to be someone with a medium budget. And the third one is someone with a high budget. So it caters for all. So the first thing is the low budget. Let's say your initial investment was $1,000 and it could be an exchange traded fund, an ETF, or it could be in good dividend paying stocks. If you're not sure how to do that, check out my last video. I'll link it in the description below. Now we're going to take the annual average return as 8%, which is on the conservative side. Because we said the S&P 500 was 9.8, FTSE 100 was 7.8. So 8% I think is a good conservative number to use. Now the time period I'm going to use is 25 years. The reason I put 25 years, generally most people's mortgages are 25 years. And the plan most people have is when they finish the mortgage, they want to retire. The next thing is your monthly deposit. So if you're putting in $100 every month, which I think someone on a low budget can do, and we're going to take no inflation at the moment. So after 25 years from the initial £1,000 and £100 a month deposits, you're going to have just over $98,000 when you retire. Now, if you take inflation into consideration at 3%, that's going to give you $125,000 when you retire. If you're in a different country, all you have to do is replace the dollars with your local currency, and that's how much it will be. So if it's in pounds, £1,000, £100 a month, it will be a £98,000 when you retire, and with inflation at 3%, £125,000. The next thing is someone on a medium budget. So your initial investment is going to be $10,000 this time. The average annual return we're going to keep at 8%. It's going to be over a 25-year period, and the monthly deposit is going to be $500. After 25 years, it gives you a value of $525,000 when you retire. That's a lot of money. If you take inflation at 3%, it's going to give you a value of $663,000 when you retire. Next thing we're going to do is look at someone on a high budget. All I'm going to do is double everything on the medium budget. So your initial investment is going to be $20,000 this time. Average annual return is going to stay at 8%. This time your monthly deposits is going to be $1,000 a month. That means after 25 years, with no inflation, you've just made over $1 million. That is amazing. That is the power of compounding. And if we take 3% inflation, it's going to give you $1.3 million when you retire. As you can see, it's so powerful. That means you can retire comfortably in 25 years time. With compounding, you get exponential growth. In other videos I mentioned, I like things that grow exponentially apart from viruses. So if it's so simple, why isn't everyone doing it? Because we are humans. This is long term. And with compounding, the money that you put in, you cannot touch at all for 25 years. It takes incredible discipline and patience for compounding to work. And any money you make through dividends, you have to reinvest. This method, you have to think long term. I would recommend start as early as you can. We've looked at all three budgets. And remember, the high budget is not even really that high. I think someone with a decent income can afford that. $20,000 initial deposit, and then all you're doing is putting $1,000 in every single month. And in 25 years, you're a millionaire. If you want to start your journey investing, you can get a free share worth up to £100. All you have to do is click on the link in the description below, open up a Trading 212 account, and they'll give you a free share. What you can do as well, you can sell that share straight away and put the money into your bank account. So essentially, I'm giving you free money. So definitely go do that. Please go like and subscribe, as this helps with the YouTube algorithm, and share with your friends, as this video can potentially change their lives. Thank you for watching.